Fast Money friend Gene Munster is listening in. Gene, I don't know if anything's happened yet. The stock is really not doing too much, and I'm wondering how you assess the quarter. There are hits and misses here.
More misses than hits, Melissa, in this. I think you need to really section this into the near versus the long term. The near term, there's no sugarcoating it. This was a disappointment. The central metric was automotive gross margins, ex credits. That was 16.3%. Missed the street at 17.6, down from 29% a year ago. This is the central metric because this is where the story hinges on. Is this a car company or a tech company? So they missed that. That trend is not a friend for Tesla right now. Second, they talked about slowing production of Model Y, production growth of Model Y. And third, the miles driven by FSD came a little bit below what I had expected. I expected greater than 600 million. They did 520, up from 300 last quarter. When you put all this together, as I said, I think that this was a disappointment. I'm surprised that the stock is not down more. I think the reason is this, is that volumes are going to pick up in the December quarter. That should be positive for margins. And I think investors are expecting on the call that's going on now for them to talk about margins improving. So we're waiting for that. And I did not answer your question, Melissa. What's happened in the call so far? In the first 3 minutes, Musk came out. He's big into AI. He described it as a massive game changer relative to FSD and how that can kind of change the world. And so it's funny, he's not talking about margins. That's not usually his forte, but it's all about what they can do in AI and FSD.
Yeah, the stock is moving around a lot. Just as you're talking, Gene, we saw a low of down 1.8%, and now it's down by just about 1.25%. In terms of those, I mean, I thought that hitting the annual number was the hit in the quarter, given the Q3 delivery miss. But you're saying that that is not enough. It's all these other things that make it just disappointing here.
If on the wager, there's 3 negatives, we outlined them. There are a couple positives. The biggest was that 1.8 million. So they're going to have a record quarter in terms of deliveries. We're enough through the quarter. They probably got some good visibility on that. So that's clearly a positive. And second is Cybertruck is going to be out. It's coming out November 30th. This is going to be positive for Tesla shares. And they don't have to sell many of them. They just have to ramp from 5,000 maybe this year to call it 150,000 next year. And I think investors are going to start to see that having a measurable impact on delivery growth. And I just want to highlight that delivery growth. I led with the negatives here. It is directionally a negative quarter, but they grew deliveries in the quarter at 28%. The rest of big auto in the U.S. grew at 13%. So they 2x what the rest of the industry is doing. Usually they do more than that, usually 3 to 4x. So that's a little bit of a softening. But either way, they're still growing much faster. And I think when you put this together in the long term, I think traditional auto is in a tight spot from a lot of different ways. And I think that Tesla's doing the right moves here, investing in the business, negative for margins, but ultimately will reap the benefits of an electrified world along with full self-help driving.
So, Gene, something that no one that I hear talking about is how they're going to monetize their charging standard. The rest of the EV space has adopted their charging standard. I've seen people call this their AWS moment. I've seen them say possibilities of a $5 billion business. How do they monetize that?
So far, they've said they're not going to monetize it. So I think that's why it doesn't get credit. But you're doing the right thing by flagging this as an opportunity for them, because eventually they're going to be the standard. 75% of cars probably will be charged on their network. I mean, they're effectively, think of all the gas stations you see, they're effectively going to replace those. And eventually they're going to turn the meter on. That's my suspicion, is they'll turn the meter on. And if you go and assume that right now with Rivian, they charge $13 a month for access. Let's say they charge somewhere between $10 and $20. It can add somewhere between 2 to 5% to earnings in the next decade. So it is something that is measurable. The reason why it doesn't add more to earnings is that the top line of the car business is just so big that even though it's going from 0 to $3.5 billion, that's my estimate, it still just doesn't move the needle as much.